There is a potential $11 trillion debt bomb due to explode this summer. The politicians and the mainstream media refuse to tell you about it, but I'm going to tell you about it, and we're going to discuss what you should be doing about it right now. So let's talk about it.
Romance for lovers only.
This is the Hey Ed YouTube channel. I am your host, moderator, and all-around nice guy, Edward Anderson. And today I want to talk to you about a very important issue that you're not going to hear talked about by our politicians or the mainstream media. But you really need to know what's going on here, and I need you to be prepared for it because you don't have to be a victim of all this. There is actually a way to benefit from all this, but this is a very serious issue. What's coming up here potentially this summer could create another huge financial crisis that could make the one that happened in 2008 to 2010 look like a picnic. So I want you to be prepared for it. These people are lying to you about the health of our economy. Let's talk a little bit about what's going on with the banks. Now, remember back in 2021, during the beginning there of that worldwide, flu that we had, I got to be careful about what language I use, right? But there was a massive increase in the M2 money supply. The government was just doling out money, just a flood of money in order to address this whole issue. So a lot of money went flooding into the banks. So the banks had all this cash on hand, and the government says, hey guys, you can't just leave that money in cash there. We need you to go out there and buy some government bonds. We need you to be responsible. So go out and buy some government bonds. And that's what they did. The banks went out and they loaded up on these U.S. government bonds. But then very soon after that, after the banks have loaded up on all these U.S. government treasuries, the government decided to raise interest rates very dramatically. Why? Because apparently inflation is an issue all of a sudden. Oops. And the Fed's most powerful tool for fighting inflation is to raise interest rates. Now, remember, bonds have an inverse relationship with interest rates, right? As interest rates go up, the value of bonds go down. So the banks have all these newly printed, U.S. government treasury bills, on their books. And they saw the value of those bonds plummet. Now, as long as they don't sell those bonds, it appears on their books as an unrealized loss because they haven't sold them yet, right? So they're just staring at a really bad asset on their books. But now the availability of cash that the banks have in order to conduct business is being eroded at a very dramatic pace. So U.S. banks right now are sitting at over $400 billion of unrealized losses. $400 billion. And I've not even talked to you yet about the issue with commercial real estate loans that are severely underwater and delinquencies are skyrocketing. And I'll talk about that more in a bit. And then there's also the issue of the exposure that these banks have, this massive exposure to the derivatives market. And if you remember back to the 2008 financial crisis, that was, the one thing that took down the financial industry in 2008, were the derivatives industry. So last year we had that big marquee bank, SVB Bank, out of California that went under largely because of their issue with treasury bonds. Okay, their balance sheets were underwater because of all these treasury bills that they held. But that same issue runs across the entire banking industry. And we are starting to see more and more banks go under because of this issue. And it's starting with the smaller regional banks, right? Because those are the type of banks that are much more vulnerable to that kind of an issue. The larger banks, they can weather this easier because they have more cash to deal with. So the balance sheets of the banks nationwide are in severe trouble, okay? Not only are the assets on their books, underwater, but people are pulling their money out of the banks. Bank deposits are at an all-time low. They've never been lower, and they continue to go down. People are pulling their money out of their banks. Have you been starting to pull your money out of your banks? If you haven't, you got to get on that. But on top of just pulling discretionary money out of the banks, people are broke. People don't have any money left. Nationwide, an average family of four has less than $400 in cash available for an emergency. People are broke, and people are starting to tap their credit cards just to make ends meet. All right, so let's talk about that for a hot second. Household debt now, nationwide, stands at $17.7 trillion. That is up $188 billion just since December. And delinquencies have increased on all loan types across the board. And leading the way are mortgages and car loans.
Here's what's happening. So in certain markets, prices rose really fast, like Texas and Florida. In other markets, the houses went up more moderately. Remember that spike we all saw right after COVID? Well, interest rates were jumping up. So in the markets where the prices didn't go up too quick, guess what happened? People went out and bought houses. Those people went out and they got 6 3/4 and 7% mortgages. Okay, those are expensive. And now those markets have gone down, and now those mortgages are underwater, but they're underwater at higher interest rates.
The primary way that the average American is dealing with inflation is by taking on more debt, and namely through their credit cards. They're using their credit cards more and more to pay for the basics, like groceries. And the national average on these credit cards are approaching a 25% interest rate. So as you can imagine, credit card delinquencies are exploding. People's credit scores are being decimated. So the financial distress out there that's being felt on both a corporate level, banking institutional level, and on a personal level is exploding. But you're not hearing about this by the mainstream press. So this is why I think that interest rates are going to be higher for longer. So during the remainder of the year here, there are $8.9 trillion worth of government debt that are maturing that they have to replace. And there are basically two ways of doing that, right? They either pay it off, which, that's not going to happen. They don't have any money, or they roll it over into new debt. Now, to that $8.9 trillion, add another $1.1 trillion that's already been spent in deficit spending, and plus another $1 trillion or so estimated by the end of the year in deficit spending. So again, let's call it $11 trillion. And that $11 trillion has to be replaced. Well, there's a big problem here, okay? People don't want to buy government bonds anymore. Look at all the BRICS nations, they're not buying U.S. government treasuries anymore. Look, whether it's the BRICS alliance making a concerted effort to ditch the U.S. dollar, or whether it's countries that just don't have any money left, who are going to buy all these bonds? But there is a scary third option here. The government could default on these bonds, or a large chunk of those bonds. And if that happens, you will see the financial crisis of all financial crises. And could it happen? You're damn right it could happen. And then, if that's not enough to worry about, we have the derivatives market to worry about. The derivatives market is, in a word, gigantic, often estimated at over 1 quadrillion on the high end. I've done videos on this before, so I won't bore you with it here. But the derivatives market, we're more exposed to derivatives today than we were at the beginning of the 2008 financial crisis. These people have not learned their lesson. And then we have a massive problem with commercial real estate loans, which is another shoe to drop that it's inevitable. It is going to happen. So a few years ago, when interest rates were at the low, you had a lot of people rushing out to buy commercial real estate. It's free money, right? And so they loaded up on all this commercial real estate debt. But now an awful lot of these commercial real estate loans are starting to go bust because there's a massive occupancy rate in these buildings. People are not going to work anymore. And it's not just, the big office spaces. It's also, multi-family dwellings that are also, underwater. So let's take a look at this chart here. So 22 million square feet of office space became unoccupied in 2020 Q2, and it has not recovered. Okay, so look, there is a plethora, word of the day, plethora, of financial economic landmines out there, any one of which can trigger the next big financial crisis. And they're not telling you about it. They're lying to you about how rosy everything is. And I don't want you to be stuck, when it blows up. I don't want you to have egg in your face. I want you to benefit from it. I want you to be prepared for it. I mean, one of the things that's never really talked about very much is that an awful lot of millionaires were created during the Great Depression. In every big financial crisis, those people who are prepared, do really, really well. And I want you to be one of those people. I want my little army here of people to be forearmed and prepared. So what's the mantra here in the channel? Number one, reduce your exposure to your bank for all sorts of reasons. Start getting your money out of the bank. Your money in the bank is not safe. Remember, legally speaking, any money just sitting in your bank is not your money. It's not considered your money. And when these banks start to blow up, you're not going to be able to get your money out of the bank. In addition to which, any money you have sitting in the bank is a depreciating asset. With inflation, you're losing, it's a guaranteed loss on your buying power. Get your money out of the bank. Number two, take some of that money, some of that depreciating asset, and put it into gold and silver. That will preserve your buying power, okay? In fact, what I think is going to happen is not only is it going to preserve your buying power, but I think you're actually going to make a nice profit on gold and silver in the next big crisis. And number 3 is establish streams of passive recurring income. Every once in a while on this channel, I give you some ideas of programs that can develop passive streams of income for you. And I do my very best to vet them really well and try to only bring you the highest quality programs. So anyway, if you can do those 3 things, you will be bulletproof. So I am running a special here today on the Hey Ed YouTube channel. All subscriptions and likes are free. So it won't cost you anything to hit that like button and the subscribe button. So please, if you don't mind, help me out by hit that subscribe button. Maybe even share the video to some of your friends. That's it for today. Ed Anderson, live from Minnesota, signing out.
Copy that.